Once I hit got it, are we going to start live streaming?
What do you mean when do you click got it?
It says this meeting is being live streamed. By staying this meeting, you consent to being live streamed.
Oh, yeah, you can click OK.
I know, but are we going live when I click OK?
Oh, it's already live.
Oh, it's already live. Okay,
Yeah.
great.
Yeah.
All right, great.
So it is on Facebook, YouTube, and I never figured out Instagram, so we'll get that later.
All right.
All right.
2 more minutes.
Yeah, 2 more minutes and then we'll go ahead and get started. Amber, where are you from?
I'm in Maryland.
In Maryland?
Yep.
Oh, you're East Coast time like Allie here.
Yeah.
Oh, let
East
me
Coast.
Oh,
show.
awesome.
I forgot to show our. Oh, I don't have the name tags set up. Oh, well, that's fine, whatever.
And Amber, what do you do for a living?
I am a loan officer. I'm newer
Oh,
to the industry.
oh, you're my girl. I'm a 20-year veteran.
Oh, I love it.
So yeah, so I can help you in all things LO.
Awesome.
Yeah.
Thank you.
Yeah.
Okay, we might just get started. You might have a one-on-one session with us today here, Amber.
Well, except for all the people on live watching, right?
Yeah,
Okay.
except for the YouTube and um, Facebook.
Yeah.
Okay. Well, let's go ahead and get started and I'll let me turn off the waiting room so people can just jump in as they arrive. I know we've got a couple others that are planning on joining here today. Allie, do you want to go ahead and share your screen and we'll start diving into everything for today?
Yes, we can. Let me know when you guys see it.
Okay,
I
looking
see it.
good.
Perfect. Perfect.
Okay, it's still doing. Girl, we might have to switch it to me sharing because it's still doing that auto dictation.
Yeah. Well, we can let it go for today and then figure it out next time. It's up to you. Either way you want to do it.
Here, we'll share it. We'll share on my end.
Okay. I'm going to stop sharing
Okay.
so you can do your thing. It puts a heat off of me anyway, then I won't have to click and mess up and I'll let you click and mess up.
Sounds good. Okay. Pulling it up.
It's like, is it Thierry Patterson's coming in?
All right. Let me start by sharing my screen. Oh, hey, Thierry. Okay, you should be able to see my screen now.
Got it.
Okay, perfect. Okay, there we go. All right, thank you so much for joining us today. So every single week on Thursday, we do a live and a webinar on different topics. So one week it's based on, it's for consumers directly, and then the other week it's going to be for lending professionals. So anyone in the mortgage lending space, real estate agents, bankers, really anybody that relies on credit for the approval process.
Yeah, I think maybe point out that this class specifically is for this webinar specifically is for professionals in the industry that would have the need for knowing credit knowledge. And then next week will be for consumers, and it just kind of flip flops.
Mm-hmm.
So as you're coming in, professionals, please feel free to ask questions. We want to be there for you to help you in any way that we possibly can to help empower your business and help you grow, especially as we go into this 2024 year, right?
Yeah, absolutely. And why don't you just jump right into introducing yourself and who you are?
Okay, well, I'm Alicia Alt. I often go by Allie, so I might interchange that, so forgive me. But I've been in the credit and lending world for about 20 years, a little over 20 years now. So I've done everything lending. So I've been a loan officer, processor, underwriting, E&O. I've done real estate. So and then credit repair is my expert specialty. So that's what I do. And I agree over here, Ivy Becker. She's also had several years of experience in the same industries, but she has a little bit different take on I was like the doer person. She's like behind the scenes compliance. She's the mean one, Amber. Okay.
I was in the regulatory
Well,
compliance
important.
space for quite a while. So I'm the one who made sure we were complying with the laws and regulations. And when everyone got in trouble, it was my job to make sure that we made the necessary changes into the processes and the procedures. So that way there was no more DOJ consent orders and other types of issues that we faced during the fallout in 2008. So a little bit about my background there. I'm also a licensed financial planner, and then now in the credit repair space. So much of my background was focused on the laws and regulations that had to do with default and credit management, which is really what drew me into the credit space initially. And Allie and myself have combined forces, and we are the co-founders of Credit Score Pro AI. We'll be talking a little bit about what that is and how that can benefit and help you as loan officers during today's discussion, but also there's a lot of information just about credit in general, really tailored to you and what you do for a living and how you can help consumers, especially in this unique time.
So,
Awesome. Thank you, guys.
thank you.
Here we go. So today's goals, we want you to walk away with a better understanding of credit scoring, whether you're new to the industry or you're seasoned. And we also want you to have a new perspective for tackling the challenges of clients in today's market, because the type of client you're seeing now is very different than what we've seen the last few years.
Mm-hmm.
So there's a major problem in our society, just in the US in general. There are 0 life lessons on credit and on home buying. And I don't know if you want to elaborate on that at all, Allie, but I think it's pretty straightforward.
It is straightforward. And as an instructor for colleges, that was one of the top things that college students wanted to know in their first year of college. And they wondered why there was not a class in it. And we think about like if gone to college and you have like your entry classes, the belief is that credit should be one of those entry level classes that people can take. And it's not there. So as an instructor, I used to teach the classes. It wasn't for credit. It was just like, if you're new into the college, you would come and take this class and I would teach you about credit. But it was one of the top attended classes, the top classes by survey that the students wanted. So it just goes to tell us that, number one, people really do want to know. And number two, that they don't have a resource to know. And a lot of the conversations that I've had with students and just anybody in general is that their parents didn't know, so their parents couldn't teach them. And then, they're having to try to figure it out. And everybody really wants to know about credit. So it's different than in the past. When I first started in the credit industry 20 years ago, people did not care about knowing about credit. It just was like, who cares, whatever. I got a 600 score, I get approved, who cares, but it is not that way anymore. People really want to know, and they want to rely on professionals in the credit industry to provide them with accurate information. That's not a myth, that's true information. And that was one of the big reasons why we wanted to do this webinar.
Okay, so let's talk about today's market. So today's market is very different, as I had mentioned, than the market previously. We're seeing a different type of client. When we specifically focus on home buying, most people are staying put if they can. They have that amazing 2.5–3% interest rate. And why would they want to give that up, right? Most people, if they are looking to purchase a new property, it's due to relocation or their first-time home buyer is entering into the market. But this market's first-time home buyer looks different. We're seeing a lot of individuals with higher debt to income, lower credit scores, less savings, and more consumer debt. And this means that everybody that was really on top and really having quite a bit of success during the last several years is having to make changes to the way they do business and the way they work with their clients. And on top of that, interest rates have been high. Of course, we're seeing, them starting to trend down, but they're still a lot higher than what they were when, a year ago or even 2 years ago.
Yeah, and I think I'd like to add to that is that a lot of my people that I talk to are loan officers and real estate agents, and they really are struggling. A lot of people have gotten out of the business because of the limited amount of sales or transactions that they're doing. And it goes to the same thing. We have higher interest rates, which is causing that. We have a lot of clients that are not able to be able to purchase or get qualified for their loan because of the higher DTIs, low credit scores, and things like that they're dealing with. A lot of this is coming out from COVID, right? So we got this major hit during COVID. A lot of people lost jobs. We're still suffering from that. And now on top of that, we have this huge inflation. So I think we just have all these compounding things on top of us, which is making it harder for the consumer, but it's obviously also for the professionals. It's taking a big hit on the professionals as well.
There we go.
There we go.
Okay. So I'd mentioned that household debt has been increasing. So I wanted to show you exactly what we're seeing. Now, of course, some of this information isn't updated based on the quarter we're in currently. This data is lagging, but what you can see is that steady increase in consumer debt. So with that household debt increasing, it really does tie hand in hand with credit scores. Part of what impacts credit is consumers' credit card balances as compared to their credit limits. So Allie, I'll let you jump in and add whatever points you'd like to make there as well.
I'm just saying, with inflation, with things being higher costs now, people are really relying on those credit card extensions to be able to just pay for their grocery bills. I'm hearing a lot of that. So I think that's one of the reasons why we're seeing a increase in household debt. And I don't think it's stopping. I think it's going to continue to grow until we get out of the inflation and more jobs come. But this has been a hard hit. I got a lot of calls recently just with people losing their jobs, right before Christmas, which is really hard. But on top of that, they already had this increasing in debt because of things being so much higher in cost. That's all.
Go ahead, Allie.
Okay, so this screen we're talking about, I can't buy because of credit. And so there's a lot of conversations about where we're at with our consumers. So we have consumers who are trying to get credit and they can't buy. So we're trying to look at the focus as a professional to change that conversation to, instead of it being a transactional type conversation with our clients, that we're now going into more relationship building, which is so important right now. Because we do have people who are having issues. And so we want to be able to provide them with the services and the resources that they need to help improve their situation, that relational type professional, right? To improve their situation so they can be approved. And I'm going to tell you guys, if you are a transactional, and a lot of us are when it's good times, right? When it's good and everything's going good, we're transactional in our business. But if you can convert to more of a relationship type professional, you're going to excel really fast in this business because people are looking for that. They're in need of that, right? So they're looking for that, but also as a relational type professional, when we come out of this slump, because you've established your business this way, they're going to be telling everybody and all their family, friends, and everyone about you because of the type of professional that you are. So I don't know if you want to elaborate on that yourself, Ivory.
Often we see these types of clients when you're helping them from a situation where they aren't sure and think it may even be impossible for them to buy because of their credit, and you transition them from something they may have just a glimmer of hope that they might qualify for to the realization that they can buy their first home or a home in general. They become sticky clients. They're going to be the type of client that is diehard loyal to you. They're not just going to refer people to you. They're going to make sure that those people come to you. It's very different when you give someone what they thought was impossible, right? They were hopeless and you made them hopeful, and then you helped them realize their dreams. Because what most people don't think about is in the industry of whether you're a realtor, a mortgage lender, or really anyone in any part of the home buying process, for a person who's trying to change their life or go from a place of trying to build wealth, the very first thing they think about doing to start to build wealth is buying a home. It is the introduction into changing not only their lives, but their children's lives forever. Think of how much wealth is built as a home appreciates and that person's able to upgrade their lifestyle over time. There's a fun fact that the people that are homeowners are 45 times more wealthy than people who are renters. So you're able to help them generate this massive trajectory change in their life, when you're able to take them from a point where they think they may not be able to qualify to qualifying. So went on a little tangent there, but hopefully that added some value.
Yeah, and I think just real quickly,
Mhm.
our new market, when we talked about our market has changed. Our new market, those people who have those really good high credit scores are not in the market right now. They're waiting
Right.
for interest rates to go down, right? Obviously. But the people who are struggling with credit and have lower credit scores, they are fine with being in the market right now and buying. They have no problem with that because they're used to, unfortunately, having those higher interest rates. So they're really their game plan, their goal is get me approved. And
Mhm.
so if you can be that person that helps get them approved, get their credit in a place where they can get approved, then you become that hero, right? And so I think that's the way that we need to focus our business now, is to be more of that relational person that is looking to help people. So in all respects, we're the hero, right?
Yeah, yeah. And I kind of skipped past this because we already talked about it. Really all of these aspects, a decline in financial literacy, a lot of uncertainty right now, higher debt, um, the impact of credit and qualifying, all of these things matter. And I think we've really made great points of that. So I think we can just start getting into the meat and potatoes of what you are probably excited to learn more about, which is credit in general, how it works, and what you need to know. Um, so Allie, why don't you go ahead and start and I'll just chime in when it makes sense.
Okay. Okay. Well, first of all, I think we can all agree that one of the reasons we are here is to get the basics on credit. As a professional in the credit industry, like whether that's a loan officer or a real estate agent, you are going to be asked questions about credit. And most of my loan officer friends, they don't have the answers to those questions. So they fumble. And in this new environment, you really want to stand out as someone who's in the know and as a professional. So this class, I think, take note, just take note, because you want to be able to talk to your clients and answer those questions without having to call me up and ask me the question and then get back to them. But if that's the case, then do that. If you don't know the answer and you're not totally 100% sure, then just say, hey, let me figure that out for you and I'll give you a call back and you call me. But me or Ivory, right? But you definitely want to be in the know on the credit, especially in our current market. So defining credit scores, I really think Ivory describes this best, but your credit scores are a numerical representation of your credit worthiness, right? So it says, if my score is this is in relation to how, we're using the word credit worthy, but how,
You want me to jump in?
what's the word I'm looking for? It's not credit worthy. It's, your ability
Your
to pay,
risk.
your risk level, right? So
Yeah.
the lower the score, the higher the risk. We all know that. That's like common sense. So if we're looking at score ranges 300 to 850, obviously if we have an 850, then we're seen as less risk. We have a 300, well, we're not giving anybody a 300, anything for 300, right? So that would be high risk. We all know that. So that's what credit scores are representing, is that ability to determine the risk level that the lender is going to incur by doing business with that person.
Right. It's really rank ordering those consumers based on that risk.
But the
So
unfortunate thing about it is now we're a number. We really, really are a number in this society, because I don't know what you can do in the world right now that your credit's not pulled for, right? You're pulled for, a lot of jobs pull credit, the
cell phone
military pulls
bills.
credit, utility bills pull credit, car insurance, home
Mhm.
insurance, everything, you name it, you're a number. And so that's why it's so important in today's world that we really need to know how this whole credit thing works.
So let's look at the components that make up the credit score. So the primary focus for the meat and potatoes of the credit score is going to be payment history as the biggest factor, and the second biggest factor being amounts owed. So payment history, I think, is self-explanatory, and the one thing that most of us are familiar with. It's your ability to pay things on time. Negative payment history is going to remain on the credit report and affect the score for 7 years. Positive payment history stays on the credit report for 10 years. Now, amounts owed, that second category, is also known as credit utilization. This is most heavily focused on revolving debt like credit cards and lines of credit. So this is looking at what is your credit limit and versus your balance, or said better, how much balance do you carry as compared to your credit limit? So it's all about ratios. A maxed out $500 credit card is going to hit your credit like a maxed out $5,000 credit card. So when looking at utilization, it looks at each account individually, but also it's going to look at the overall total of the credit utilization on your report as a whole. So all accounts combined, balances versus credit limits combined. Anything you want to add in there, Allie, about those two categories before we move on to the bottom three?
Just a quick tip on the 30% of your score is your utilization. Oh, what happened?
I think we lost you, Allie, for a moment.
Oh, am I there now?
Okay, you're there now. Go ahead.
Okay, sorry. So I was just going to add on the 30% of the utilization, you had mentioned that a $500 credit card if it's maxed out.
Mhm.
So people don't know this, but that can drop your score just by one credit card being that way. It could drop your score 100 points. And so that was just a little thing I wanted to say, because there are banks out there that will say, hey, get this credit card, max it out, and then pay your minimal payment to build credit. And that would be an incorrect, that would be a myth. So you definitely don't want to have your balances exceed 20% of the credit limit. That would be my recommendation on credit cards.
Right. And then one of the more important things too is when you are advising your clients on what they should be focusing on paying, it's going to be the credit cards. It's not going to be the loans. If
Right.
they're looking for a credit limit increase or not a credit limit increase, a credit score increase.
Credit score increase. Yeah. Well, hey, if they focus on that, they may get a credit line increase as well. But yeah,
Right.
So, and even like if we're looking at a credit report, we're trying to get the best, the most scores possible. We're going to look at the credit cards first and see the utilization.
Utilization can be an easy fix. So it's always the go-to solution for you if you need something that's faster than some of the other options that are available. Now, another factor on the credit report that I'm going to focus on is the 15% length of credit history. This is often overlooked. The average age of open accounts on your credit report. That's another way to put it. So key word there, open accounts. So when that client closes that credit card that's been open for 10 years and they see their score drop, that's why they adjusted that average age of open accounts. When they have a lot of longevity on their credit file, they haven't opened new credit in a really long time, and they all of a sudden open that new account that's 1 month old and it adjusts their average age, their score drops. They pay off that loan. Here's a common example. We've got debt to income issues. We need to make sure that car loan's paid off. So we need you to pay that off so that way we can put your debt to income within the proper parameters to qualify for the mortgage. Have that paid off as part of closing. Don't have that paid off before the closing date, because otherwise what you're going to see is, again, that drop in that average age of open accounts, and it can really negatively impact their scores, but also change the entire structure of that loan that you put together and maybe kill the deal. So that's something that we often come across with those in the lending space that they don't realize is going to cause potential issues for them.
Yeah, and I get that one a lot. Or a client will call and say they're so happy their credit score is improving because they paid off their car loan. I'm like, no, call me first. Don't pay off the car loan. So I think that's really important. And the same thing with like, if I'm working with a client and we need to, maybe refinance an auto to get the debt to income ratio down, maybe we're not paying it off. There's a fine line of when to do that so that we don't affect the credit score. Yeah.
Exactly.
Great point.
Exactly.
Great point.
And the last two categories are credit mix and new credit. So credit mix we'll focus on first. Credit mix is really looking at your ability to pay different types of debts or to manage those debts responsibly, said better. Essentially, that credit score algorithm wants to know that you are as responsible with a credit card as you are with an auto loan, as you are with a mortgage and any other type of debt. So have you ever, perhaps some of you have come across a scenario where you have a friend or family member or even a client who applied for a car loan and they got declined and they don't understand. They have a good credit score, but all of their credit history is just credit cards. Well, it's because they don't have a history of any sort of loan on their credit report. So it's a signal that I don't know if you can pay this type of debt effectively. So credit mix isn't overlooked, but a very important factor. And your credit score is rewarded by you being able to show you've had success in managing all sorts of types of debt on your credit report. Because remember, your credit score is all about your ability to manage debt responsibly. It is not about your income. It's not about your age or any sort of demographic factor at all. It's only solely focused on your management of debt.
Yeah. I might add that to that, if you are discussing this with a client and maybe they only have loans and don't have a credit card, fine, help them get a credit card. We have Credit Score Pro has a lot of credit building resources. But on the flip side, if they have credit cards, but they don't have the loan, we don't advise people to go out and go buy a new car, right? That we should know, or go get another loan. But what we do have is we have a resource like it's called Self, and it's really a savings account that's going to report to the credit report like a loan. So it gives them that extra part of the credit mix that they need without actually incurring new debt, but we're actually saving.
And without like really hurting that debt to income ratio, right?
Right.
We don't want all of a sudden a new $350, $400 payment showing up, right? So that tool that we offer with Credit Score Pro is meant to mitigate debt to income while helping to improve credit and helping them save, which is a good habit that everybody needs.
Very much so. Yes.
So last category is new credit. New credit and inquiries, I usually like to add that on to there. So final 10% of your credit score, inquiries are something that most consumers are deathly afraid of. Inquiries are not as impactful as many would think. And I encourage you, we do have several videos on inquiries that we can send your way too, that are really good for helping to calm consumers' nerves when it comes to preparing for that first pull from the application. So inquiries, about 1 to 3 points on average. It can be a bit more, but the important thing to know is when you first apply for a mortgage, that consumer's credit isn't going to be impacted right away. There is an actual waiting period of 30 days before they're going to see the impact of that inquiry. And on top of that, and another thing you should know if you are in the mortgage industry is what's called the 45-day dedupe clause. Essentially, any inquiries for when that consumer is shopping around only impact their credit once. They're going to see, let's say they had their credit pulled 2-3 times for a mortgage application. They're going to see the 2 to 3 inquiries on their report, but the actual score impact is only 1 inquiry's worth of impact. So again, roughly 1 to 3 points. Now, somebody that does have what we call a thinner credit profile, really just meaning a lack of credit history, they may see a bigger impact to their credit score because there's less information, less data for that algorithm to go off of. But the general rule of thumb is inquiries aren't worth too much. It's better to get the right product. And if they're coming to you after they've spoken with another mortgage lender, it's a good thing to have in the back of your pocket to properly advise them and help them feel better about making the decision to make sure they're getting the best loan possible for themselves. So
yeah, just to you said it all, and I'm just going to point out something again. As a loan officer, I don't do loans anymore, but as a prior loan officer, I would have clients call who had gone to a different lender and then heard about me and came to me. They already had their credit pulled, so they were very iffy, like, oh, do you have to pull my credit? And like, of course I do, in order to figure out what rates I could give you and things like that, right? So I have to, but knowing that if they're doing those credit pulls, namely in a 30-day period of time, it's only reflected as one. Okay. I don't know, I just clicked on something. Anyway, it's only reflected as one. So you can encourage them to continue to move forward with you without it negatively impacting their credit score. And I think that's really important because you're going to have that. It's going to come up for sure. At some point in your career, you're going to have that.
I keep clicking the wrong thing to move on to the next slide. Okay, there we go. Okay, so let's talk about some of the problems with credit for consumers, or just in general. So problem number one, why credit is confusing for consumers and maybe for you too. We talked a little bit about it, lack of education, but it gets even more complicated or confusing when we had the introduction of the Vantage Score model. So Vantage Score is let me take a step back. We're all familiar with credit scores, the numeric representation of your credit worthiness, right? Now, there's actually multiple types of credit scores. There's the FICO credit score created by Fair Isaac Corporation, and that's what you see when Equifax, Experian, and TransUnion generate your score. You get your credit pulled, you go to Experian's website, you use many of the credit monitoring tools, you're pulling your client's credit as a lender. That is going to be a FICO credit score. We also have what's called the Vantage Score, which was developed by Equifax, Experian, and TransUnion as an alternative to the FICO score. Essentially, the three bureaus don't own the FICO score. They don't like not having that ownership, and they wanted to create a score for themselves. And so in 2006, they developed the Vantage Score. Now, even though there are two different models, this Vantage Score and the FICO score, they both do look at the same type of information. The weighting of that information is different, right? We looked at, if we go back to this prior slide, the weighting here for the FICO credit score, the 35% history, 30% utilization, 10% new credit mix, and 15% credit history. So if you notice on this image, that weighting is a bit different on that Vantage score and that FICO score. This weighting and the interpretation of the information within the scores causes differences in those credit scores. And what I mean by the interpretation is the way payment history is looked at may be slightly different between Vantage and FICO. And these factors combined make those scores different. So if you've ever had a client come to you that says, well, I checked my credit score on Credit Karma, and they told me that it was 730. But when you pull my credit score, you're telling me it's 680. Why are these scores so different? It's because of this. That Credit Karma score is that Vantage score. And you're pulling a FICO score. Allie, what do you want to add into this? Because this can get really confusing for people. So I'd love you to help make even more clarity.
Yeah, this is a very complex thing, but I think that the main point for you to know is you will have clients come to you and say, I saw my score and my score is XYZ and you're telling me this and you're bad, right? And I'm going to go to a different lender who's going to give me the score that I see when I pull it, right? Well, it's just not true. We all know that you're going to go any place you go, you're going to get the same score. But this particular slide shows you the Vantage 3.0 scoring model, and then you have FICO 8 scoring model. Mm-hmm. What you guys are using in the lending space is FICO 5, 4, and 2. Yeah, so we're going to get into that, but that makes it even more complex.
Here, we'll skip through it now. That's fine.
Okay, so FICO 8 is, I would say, if we were looking at Vantage versus FICO 8, FICO 8 is going to more relate to the mortgage credit score than Vantage will. Vantage is pretty off from what FICO, the mortgage FICOs would be. But know that I call the mortgage FICOs the mean one. I just like to, that's the way that I like to do it. So they're going to take a bigger hit on things. So I'll give you an example. If you, and this is a common myth I hear in the lending world, they'll say, we don't care about medical collections, which you guys don't. You don't care about medical collections. I get that. I understand that.
For qualifying.
For qualifying. But what a lot of loan officers don't know, because they just hear that. They just hear, we don't care about medical collections. So when they're looking at someone's credit report and they see a poor score, they go, oh, handle all this, but don't worry about the medical stuff. And that would be wrong, because the medical collections have just as hard of a hit to the credit score as any other collection. So if we're looking at building someone's credit, it might be medical that we tackle first. And the reason for that is because of the new rules that the credit bureaus came up with, which is if you're if a medical collection's paid off, it's removed completely from the credit report, like it never happened. Or if it's paid under 500, it's completely removed. So those are easy ways to improve credit really fast by taking care of the medical, even though that's not necessarily a qualifying issue for a loan officer. So I want to point that out because I hear that a lot in the lending space, and I have to clarify that a lot. But if I was going to look at a credit report and I needed to improve someone's credit and they had a bunch of medical collections, I'm going to say, hey, let's start wiping these things out because I'm going to get a bigger improvement in the credit score for the mortgage credit report. That's not necessarily the same when you're looking at FICO score 8. Okay. But for the mortgage, that is true.
And I'll add to that too. Another thing similar is late payments. With FICO 8 and many of the newer versions of the FICO credit score, as those late payments age, as they're once they're more than 2 years old, they become less impactful to the credit score. The FICO Classic models used in mortgage lending, that's not necessarily the case. So you're going to see a bigger hit from those late marks that are older on a mortgage FICO score than you would on a FICO 8 credit score, for example, or even that Vantage score used in Credit Karma. So taking care of those or getting those late payments removed can help to pull up that FICO Classic score used in mortgage lending way more so than what they'll see in any other type of credit score you see on the screen here.
Yeah. Another important variance, I would say, is someone building new credit. So if we have a person who is new to credit, they don't have any open credit. Maybe they've had credit in the past, but it's all closed. Well, that doesn't really count anymore. So when you're looking to, they want to buy a home, let's say, and they're doing the mortgage credit report, they're not going to produce a score for a new credit card until that credit card is at least 6 months old. So they have to have some kind of credit for at least 6 months to create a score on the mortgage credit report. And this is important for you to know because if they go on to Credit Karma, when they get that new card, immediately they have a higher credit score.
Right.
And so that can be very confusing.
So Credit Karma, or this Vantage score model, does a great job of allowing people to generate scores faster than most of the FICO scoring models, and especially the FICO scoring model used in mortgage lending. So that is one of the benefits to it, is it allows more people to have access to credit. And as we see transition and change in the mortgage space with the credit score models being used, we will start to see some of the introduction of that, but we'll save that for another webinar.
Got a couple of years before that happens anyway.
Transition starts in 2024, baby.
I know it's gonna be interesting.
It's slow transition.
Yeah, it'll be interesting.
Yes, so I guess that's Vantage, that's FICO. Here's a little bit more of some of the differences. Let's take a look. Is there anything here we did not cover, Allie? Let's see.
I think I want to just say one thing. So we talked a lot about the mortgage. Obviously, all mortgage professionals use the old mortgage model, the 5, 4, and 2. Number one, you're not going to go anywhere and get a different model. So that's number one. And I like to inform my clients of that. FICO 8, though, is a scoring model that is used by almost, I would say, the majority of lenders out there besides the mortgage industry. So if you're getting like a credit card, a car loan, things like that, they're using that scoring model. There's also a newer model. It's at the bottom of the screen. It's called FICO 9. There's now FICO 10, FICO 10T. Those are also new scoring models. Note that FICO 9 came out and it had a lot of great things going for it. And a lot of people were super excited. There's a lot of myths in the industry because of FICO 9, because people think that we use it. There is, I think they said 1% of the lending industry uses FICO 9. So anything that you've ever heard about FICO 9, throw that out the window, because you're probably never going to encounter a bank that's using that system. But it is a much nicer system than FICO 8. You would have higher credit scores. Simply no one's using it. And then FICO 10 and FICO 10T, no one's using those either. So if you hear anything about those right now, just set them to the side. That is going to be new news. That is going to be important coming in probably, I would imagine, the second quarter of 2024 when we start to hear a little bit more about it.
Mhm. Yeah, and of course we'll have an entire live and a webinar just about that topic because in it of itself is a full experience to discuss.
Yes.
So this is another reason why there is so much confusion for consumers, right? We talked about Vantage scores versus FICO scores, but then now each score is broken down into its own generations. You can think of this like you've got your iPhones, right? And every year or so they come out with a new iPhone with new features and they make changes. Now, each of these models from 2 all the way to 9 and then 10 and 10T, they're tweaking the algorithm. And the whole idea behind making the adjustments to the algorithm is we'll take a step back and we remember what's the point of a credit score? It is to determine it's to measure risk accurately, right? What's the predictability that that person will be able to pay a new debt on time or the existing debt on time? So as consumer behavior has changed over time, the algorithms have changed with it. And that's what each of these models represent, is making those adjustments and changes to keep up with the pace of change in consumer behavior and then become a more accurate predictor going forward. And then these industry specific variations are really hyper focused on that industry. What is the predictability specifically for auto lending? What is the predictability specifically for credit cards, right? Because a credit card company might not care as much about the history of payment on auto loans and vice versa. So what's important to know is consumers are going to see these different credit scores from these different sources. And this is why there is confusion. So you can put it simply, you actually have multiple credit scores. They are all correct. They are all accurate. They're just used differently. And if you maintain the proper behaviors, all of your scores are going to benefit. At the end of the day, that is really all you need to know at a high level. And if they start having those more intricate questions, as you become more familiar with credit scoring, you'll be able to answer those, but you certainly don't need to be an expert right away. And if you have the help of Credit Score Pro, you certainly don't need to be the expert because it'll do it for you and it will help your clients do it as well.
That was a great summary. I would say just a little story about this because I love that you said that all credit scores are accurate because they absolutely 100% are. And so you'll have clients say, well, which one's right? They're all right, depending on what you're trying to do. So with Credit Score Pro, we have a program where it does a credit action plan, and the credit action plan will give the client action steps to do to improve their credit based on their goal, because it's, again, looking at those factors that are involved for those different credit models. So I'll give you a quick story. So my husband and I went to go buy a new car, and they pulled both of our credit scores, and my husband's score was higher than mine by quite a bit, actually. And I was like, no, my score is always higher than his. But the reason that on that auto lending, he had a higher credit score is because he had auto loans on his credit report. I did not. I hadn't had an auto loan in my name for 10 years. So I had no auto. You would never thought that because it's off after 10 years, that good history is gone too. So if you looked at my credit report, you would have thought that I'd never gotten an auto loan in my life, right? So when the auto loan model works, it's also looking at what's your behavior on auto loans. Oh, you've never had one, or they seem to think that you never had one. So now my score is lower. My husband had just had one for the last few years, so he had the higher auto score. So it gets very complex. You definitely have different scores everywhere you go.
Allie, and I'm sure some people may be wondering, well, why does information expire off the credit report? Why does it come off after 10 years? And why, when an account closes, is it no longer part of your credit score calculation? And the answer behind that is, if it's a predictive model based on your ability to make payments or pay things on time, it wants to know, what are you doing right now? Because if it doesn't know what your behaviors are right now, it can't predict what your future behaviors are. Because the way I was 15 years ago is very different than the way I am now, right? The way we were in college with our responsibilities is very different than we are now, right? So that algorithm, you want to think of it as a kind of a live tool that's constantly changing and morphing based on your behaviors changing and morphing over time too. So
And, lending professionals probably know this best. We're looking at the credit report and we're looking at your activity, regardless of your score. We're looking at your activity in the last 12 months, right? Because that's a really good predictor of whether or not you're going to pay that mortgage loan that you're getting. So I think that we're used to looking at those numbers in terms of not just what the score says, but what have you been doing the last 12 months or the last 24 months?
Yeah.
Or what haven't you been doing that you should be doing?
So let's talk about the next problem. And this problem is more geared towards you in the lending space. So you want to do more, but the lender reports and tools have limited options to help your clients improve their scores. This is something we hear quite often is, I have tools available to me, but they only help so much. So how do lender reports differ from consumer reports? And Allie, you can definitely jump in here. The lender reports are a tri-merge report, right? So all of that data is merged together, meaning you don't see the differences between Equifax, Experian, and TransUnion. What you see instead is one account, right? You're not seeing, let's say, I don't know, Chase credit card on Equifax, Chase credit card on Experian, Chase credit card on TransUnion. You just see Chase credit card. I should have shown an example, but it's okay. And this also means you can't see differences across the 3 credit bureaus. You may not be able to see the impacts of the removal of negative accounts from credit reports with the tools that are provided to you, and you may not be able to see errors or issues on the credit report because it is a merged file. Meaning, oftentimes in the credit space, we may identify that there's a 30-day late mark showing in August on Experian, but there's no 30-day late mark in August on Equifax or TransUnion. Or maybe it shows in September on one bureau and August on the other 2 bureaus. These are all things you can't identify or see, and one of the limitations of the lender credit report.
Yeah, I think that's important, right? Like the example of one of the credit bureaus maybe reporting a late and the other 2 aren't. When you pull in that tri-merge credit report, you're going to see the late as if it was just what everyone said, when it necessarily is not the case. 2 of them could have said, hey, it was never late. And that's really important to know.
It could be a flag to signal, hey, that consumer maybe never was late, and maybe one bureau is reporting an error, right? And then if you saw that, you'd be able to say, hi, Mr. and Mrs. Client, I noticed this. Is this right? Is this something maybe you need to talk to that creditor about, right? But you have that limitation. You don't have that visual insight, unfortunately. So actually you can kind of see I didn't mean to do that. You can kind of see on the screen here, here's a little section of a lender report where you just see the one account. It's cut off, but yeah, Allie, I'll let you talk a little bit about this slide.
So I think the biggest point I want to say is going back to kind of the other slide too, and just in general. So you have the tri-merge credit report, you're limited on what you get to see. And that's the same thing on the consumer credit report. So one of the big issues when people are trying to improve their credit, they're looking at a consumer credit report. Maybe they're looking at Credit Karma, which gives very little information, or maybe they're, getting another credit monitoring source and they're seeing credit report. The issues with that, they're all great, valuable information, but they're missing a lot of the pieces. They're showing the vendor is showing what they want the consumer to see, not necessarily the full picture. Behind the scenes, there's a whole nother report, not a whole nother report, is the real report. It's called the raw data report. It's not a whole nother report. It's the real report. It's got everything on it. And we don't see that. And we're never going to see it. We're never going to pull up a raw data credit report unless you're behind the scenes in the industry like Ivory and I are, where we would see a raw data credit report. But I'll give you an example. You have a 12-page, 15-page credit report that you see, and the raw data may be 500 pages long. There's a lot of data in there. There's a lot of information for each individual credit bureau, right? And so if we were able to see that, not that we really want to be honest with you, because that's a lot of looking.
Not fun to look at.
It's not fun to look at. This is a computer world, right? To do that. But if we were to look at that, we would be able to see all these different errors that are reporting on this consumer's credit report. And the reason that that's important is because if there are errors, they have to be fixed or removed, right? So a lot of people have information on their credit report that should not be on there. And that's preventing them from being able to purchase a home or do whatever they want to do with their credit. And that's errors on a credit report, some of which we don't even see with the naked eye, right, are existing on credit reports, which is not legally allowed to be. And thus people are being dinged on their credit, getting higher interest rates, not getting approved, whatever, because of that. And so
Right,
Credit
'cause it's
Score
lowering
Pro,
their scores, right?
yeah. So Credit Score Pro, being AI technology, is able to read that raw data credit report, the stuff we don't see, and it can find all those errors so that it can seek to get the negative information removed because of errors and inaccuracies on the credit report. It can actually see them.
So I think a good example of that too is just a single collection. It's often within our world that loan officers will refer individuals to Ali and myself, and they will have started the process with a 800 or even above an 800 credit score, and all of a sudden a single collection pops on the report. Oftentimes these collections are not valid, and essentially we see a lot of like Comcast collections, utility bill collections, I mean everything under the sun. Maybe that bill was already paid. Maybe they're being charged for whomever had moved into a unit after they had already left, right? We see all sorts of issues and errors. A lot of collection agencies have no proof that that consumer owes the debt. I mean, the list goes on and on. That single collection can drop that 800 or 800 plus credit score all the way down to a 680. What does that do for your pricing? I mean, that changes the entire loan. And so it's really important to understand the impact of the errors on the credit report, and to know that when you are running that wayfinder, I think that might be the next slide. When you are running that wayfinder, and when you are using Credit Expert, whatever tool that you have available, often it's not going to be focusing on those. Actually, it's not going to be focusing on those errors. It's going to be focusing primarily on paying cards down, which is helpful, but it's the tip of the iceberg in the possibility for the consumer score improvement. And we talked about why that's so important, because the type of consumer that's coming into the market now to buy is that consumer that's not your premium credit score client. They are the people that are in the 400s, 500s, low sixes. And we want to make a mortgage affordable, right? And this means putting them on the path to better credit. And so these turnaround times for these types of transactions can be longer. It's not going to be your apply a week later, 2 weeks later, they're approved, they're in contract, they have the house by the end of the month, right? This may be the time in the market, which it's always ebbing and flowing, where you're building a long-term pipeline. And the more people you put in that pipeline, the more closings you're going to keep feeding yourself. And then all of a sudden, when the tide turns, you have this giant pipeline of people that had credit issues, that are fixing their credit issues, plus all the easy stuff, right? And you just have this constant stream of business. No matter where the market is cycling, you're constantly being fed, and you're going to be in that top 20% that's doing the business when the other 80% can't. And so I guess that's really what I wanted to highlight is these errors are opportunity. It's opportunity for you to close the loans that no other person can. And you don't have to be the credit expert to do it. You just have to know that the problem exists, there's a solution, and you can help your clients with finding that solution and then getting them to the closing table. So.
And I would like to add to that, I have some loan officers that I work with that if their client comes into them and they have a score below a 760, they're sending them to Credit Score Pro. And the reason for that is because if you have a 760 or higher credit score, you're going to get the best rates. And so they really want to be the hero to that consumer and saying, hey, I'm looking out for your best interest. Yeah, I can get you approved for the loan. We're going to go ahead and move forward with that. But I really want you to continue to improve on your credit to get to that 760 range so that you can get the best interest rates. And it's a smart marketing tactic right now for even people who have those higher credit scores, because now you're capturing those people who are like, wow, I didn't know I needed a 760 to get the best rates, and I want to get to that point. And right now is the best time to go find those people and market this stuff, because we will have a refi boom. It's going to happen. We don't know when, but we are absolutely 100% going to have one. And so why not be in a position where people know that you're helping them improve their credit to get them to that 760 range? So when the refi boom happens, they get the best rates and they're off and running. I mean, this is the best time to market this type of product. Yeah.
So I wanted to, it's kind of a step back and talk about what is credit repair. We've already been talking about it. Credit repair is the process of working with the credit bureaus, collection companies, creditors to remove negative information from the credit report. And the often forgotten piece is helping to improve scores outside of negative information, optimizing what's working well in the credit report and filling in the gaps where that client is not impacting the credit algorithm. So information that is negative can be removed. Oh, I got a spelling, can bet removed. Anyway, can be removed because of a lack of compliance in how that information is reporting. That's the key. It's not about whether that client did have the account charged off, did originally owe a creditor and now it's sold to a collection agency. It's about the laws behind what is occurring on their credit report and how debt collection efforts are being done. So it's all about laws and adherence to the laws. And consumers, professionals, I don't think anyone is sitting there reading, the 274 pages of law. Actually, I think it's a different page number. Last I read it, it was 274 pages of the Fair Credit Reporting Act, right? We cannot expect our clients to be the experts in the laws. And we can't expect professionals in lending to be the experts either, which is really why we created Credit Score Pro. And we wanted to highlight a little bit about what most people don't think is possible in getting taken care of, or better said, getting removed from a credit report. So things like late payments, collections, charge-off, repossessions. If you identify compliance issues, with mismatching information on the bureaus, incorrect months marked past due, marked past due when they paid on day 30, marking, gosh, all these typos, marking past due because of internal processing time issues, mortgage servicer changes, lack of proper validation, contract statements on collection accounts, showing incorrect or mismatching balances on charge-offs, repossessions, collections, not showing the proper information on different types of collections. There are certain laws around collection agencies required to have an NMLS, pretty crazy, right? To collect in 7 states in the US. Creditors purging or missing documentation, not sending proper notices. And the list goes on and on, right? There's so many issues that can exist that can allow that consumer to get that negative information removed, see a benefit in their credit score, while at the same time working on optimizing those good things on their credit report and adding good information when they're not influencing the credit score algorithm. And now all of a sudden you had that client that came to you is like, hey, I really want to buy a home. I know I'm not in a position. I'm at a 400, I'm at a 500 credit score, but I will do anything I can to get there. And 6 months, a year down the road, maybe less, they're at that point of either minimum qualifying or beyond those minimum qualifications. You help them get a home, you help them refinance later, and they're sending everyone they know to you. So this is what is possible that is extremely overlooked by the lending industry. And with this change in the client base, this has to be the area of focus if you want to survive. So that's my my soapbox for today.
Hey, can we add bankruptcies to that?
Oh,
Bankruptcies are another
absolutely.
thing
There's a
that
lot
can
of
be
compliance issues
removed.
with those.
Yeah, there's a lot of compliance issues around that. So the information for bankruptcies is coming from LexisNexis. That's feeding that information to the credit bureaus.
Mhm.
The credit bureaus are required to verify that information. They get that information from LexisNexis, who got it from Pacer, who Pacer got it from the court database. So the point is that LexisNexis is a third party, and the law says that it has to come from the original source. And so that creates a compliance issue with bankruptcies, even reporting on the credit report. So those are also things that oftentimes are overlooked that can be removed because of compliance issues.
And beyond that, it should be recertified every 90 days. If you speak with any bankruptcy court, they're not going to resend the information to any reporting agency, credit reporting agency, after that initial 90-day notice that they provide. So there's lots of opportunity that exists. So.
Yeah.
So let's talk about, we keep mentioning Credit Score Pro, and I suppose it's kind of vague because we haven't really discussed what it is and how it can help you. So Credit Score Pro is an AI tool that spots errors on the credit report. So it automatically scans the credit report for issues, compliance issues, discrepancies that a human eye can't detect, right? It's looking at that raw data report that Ali had mentioned that can be that 500 pages long. It's looking for unusual activities, changes when it's comparing old reports to new reports. And it identifies significantly more opportunities than Wayfinder or Credit Expert can when we look at its ability to create credit action plans beyond just that ability to detect negative accounts on the credit reports. Then it goes beyond that detection and it automatically creates the dispute for the consumer. So no longer does the consumer have to figure out how to be an expert or get sucked into those BS social media fads that tell you this is the new way to get information off your credit report. It's proven disputes with a real AI that actually learns based on the history of past disputes. So that being said, the success rate at this point is now an 80% success rate of removal of negative items by the 4th round of disputes, which is a faster turnaround time than those of us who have been doing that full service credit repair for years. Even though we are experts and we're the best in the industry, it beats us. So it's going to put us all out of business when it comes to.
It sucks to say that, but it beats us. Yeah.
So I don't know. What would you like to add to that? That was pretty high level explanation of Credit Score Pro. And don't forget, there's more.
There's more. So I'll let you go to the more and then I'll elaborate.
Maybe.
How about that?
Thank you. There we go. This is you.
Yes. So, Ivory was talking about how Credit Score Pro provides action plans that are way better than like Wayfinder and Credit Expert can do. And matter of fact, I've seen a lot of Wayfinder and Credit Expert reports because I have a lot of loan officer friends. They send them to me. And sometimes a Wayfinder or Credit Expert report will come back and say, there's no help for this person. I don't know how long you guys been in lending, but if you have had that, hit me up in the chat and tell me that you've had that, because I think that's hilarious. Of course, someone can help improve their credit. There's nothing can help this person, right? But Wayfinder actually will say that sometimes. But the other thing that I found with Wayfinder and Credit Expert is that they're not using really the credit algorithm for the mortgage world. They're basing it on trial and error. Okay. Based on the data of people that they have in the system. But I'll give you an example of a trial and error that Credit Score Pro, or not Credit Expert. Am I still there?
Yeah, you're here.
Credit Expert. Like your screen freezes every few seconds. So I'm wondering. Credit Expert and Wayfinder. I'll give you an example of one error that they give. So they'll say that a person needs to put a balance on a credit card in order to improve the credit score because their balance is currently 0. That is a myth. That is not true. It only applies if the person hasn't used the card recently. If there's activity on the card, there does not have to be a balance. That is a huge myth in our world. But Wayfinder actually tells lenders to tell their clients to do that. So that's just one general thing that they have errors within their system.
Hey, Allie,
but
should I show an image of what those action plans look like?
Yeah, that'd be great. Yeah.
Okay. You keep going. I'm going to bring it up on the screen.
So Credit Score Pro actually creates these action plans that are geared towards the person's specific goal. So remember, we talked about the different models of FICO. So this would correspond with those models. So for instance, this person's goal in the middle, if you see your goal, your credit goal is to buy a house. All the action steps below that are the action steps to help get them closer to being able to buy a home. So they may have several action steps, but the way that it's set up is like if it's red, that means they need to improve that area. If it's green, they've already done that. Okay. So it's very easy to read, but it gives them instructions on exactly what to do. And for instance, let's look at like action step 1, just real closely. We have a credit card. We need to pay down that credit card. And then it's giving the balance owed and what amount it needs to be paid down to. Okay. And so that helps them. So they have a real target of what they need to do. And it gives the little instructions at the top to activating cards. So this is where Wayfinder is wrong. like this one says activate cards. So this person has 3 credit cards here that they have not used in a long time. So they have a 0 balance, they haven't used it. So it hasn't created activity, which is preventing that credit score to improve. But had this person been using it every month, but paying it off every month, that card would not be in that section because it's allowed to have a 0 balance without negatively impacting the score. We don't have to have a balance on credit cards. That's
But
a
we
huge
want it to influence that algorithm, right? Remember,
right. So we have to have activity. Activity has to be there, and it doesn't have to be every single month, but activity has to be there. So the rule of thumb is it needs to have some activity within 3 to 4 months. Otherwise, it becomes inactive, which then is not helping
Yeah.
improve the credit score. Mhm. Yeah.
And someone else's action plan may be a lot more comprehensive than this, right? They may have a lot more steps. I know I just pulled this one up, but I know we looked at one on our last our last live last week or 2 weeks ago, and that person had, I think, like 6 steps.
6 steps, yeah.
So it'll depend, right?
Yeah. Because they might have student loans that are the way that the student loans are being handled is preventing them from being able to have the higher score. So it'll indicate what they need to do with student loans. So it's, again, it's tailored to that specific person's credit report and their goal.
Okay. Oh, and the other piece is, I think, Allie, you may have mentioned this, but you choose the goal. So based on them choosing the goal of buying the home, it's going to focus on, I'm going to take us way back here, but it's going to focus on this algorithm that you use in lending. What is needed for this credit score algorithm to get that algorithm score higher, right?
Exactly.
So, all right, I'm getting there. And then, of course, as they achieve each step, they can generate a new action plan, and it's going to reorder the new priorities.
Yeah. And I recommend that they just get a new action plan every month so they can see what they've accomplished. And, it's in green, so it makes you feel good. It's still on the list. It says you got it done. But then they also, if something new pops up or some new issue happens, they are notified on that for their action plan.
You're going to have to give me a minute and buy me a little time to get this pulled up.
Buy you a little time. You should log that in. Does anybody have any questions about what we've talked about so far, or maybe a situation that you're currently dealing with in your industry that we might be able to help you with or answer? And don't be shy. I also have a chat that I have put some information in. I said hi to everybody, so say hi back to me. But also I have a link in there. If you would like to become an affiliate of Credit Score Pro, you can click on that link and we can set you up as an affiliate. So as an affiliate, what that does for you is you'll have your own link that we can track who your clients are that are using Credit Score Pro and be able to inform you on their progress.
Okay. So here's Credit Score Pro in action. This is a demo account, so we're not showing you anyone's private information. I think that's first and foremost important.
Yes.
And this is what the homepage.
Sorry, I was talking to Amber.
Oh, sorry.
Sorry.
And this is what the homepage or that initial dashboard is going to look like when that user logs into Credit Score Pro. So issue number 1 in credit repair is a lot of clients don't know what's going on. Traditional credit repair can be expensive for consumers and unaffordable. Credit Score Pro's AI is free to our users. So the only thing that the client is paying for is to access their credit reports. And at the same time, it's not an inquiry, right? So they are able to access their reports and scores, utilize that credit monitoring, get access to Credit Score Pro's AI for the disputing of the negative information, the credit building action plans, and on top of that, the credit education platform. So
hey, wait a minute. Did you say free?
Huh?
Did you say free?
I did say free.
Did you say it louder? It's free.
The AI is free.
The AI is free. That's really crazy.
So, I should go over what is the cost to access reports. Well, it's a lot less than what it is for you on the lending side to access reports. That's for sure. So clients are accessing their reports for $39.99. And so that's the cost, $39.99 for one new report each month. And from here, once they log in, they are able to fully use the AI. I'm going to start with just looking at the credit education because I think it's just a simple place to go first. So along with them working on improving their credit, we do want to make sure we're focusing on financial literacy and creating responsible credit management over time. So if they go to the tutorials, oh, why is it making me log in again? Are you seeing the same thing I'm seeing? Hold on.
What are you looking at? I'm seeing your dashboard.
Yeah, when I click,
Is it making you log in again?
yeah, hold on. I
That's
got a
happened to
new
me
window and
before.
it's working.
Yeah.
Okay, 1 second. We're gonna share a different screen. Okay. I'm getting it confused because they both look the same. Okay. Put that here. Share this screen. Share. Okay. Ooh, it's like giant. Okay, there we go. I don't know why it was trying to make me log in again, probably because it's a demo account. But anyway, so they'll go to their dashboard, they'll click tutorials. This first section will show them how to use the software if they need it. But if they go to coaching, this is where we have the full education.
Ivory, you are showing your back end screen, not the front end screen.
Okay, let's just try again. I'm going to share just this whole screen right here. You can see it?
Perfect. Yes, yes.
Okay. So I'm just going to share the whole monitor, I guess is my solution.
There you
Okay.
go.
So let's take a step back. They're going to click tutorials. The first section in here is how to use Credit Score Pro. The second section under coaching is the credit education platform. So this is where they can see every different section about credit, from why credit matters, understanding the credit algorithms, breaking down the factors like the payment history, utilization, all those pieces we went through. And it's all in small bite-sized pieces. So if they have a question about bankruptcies and credit reporting, they can go there. Or how payment history impacts your credit score, how positive and negative payment history impacts score, etc. They can go to each of these sections and learn exactly what they want to know about credit. It even goes into common credit myths, right? This section is going to help you out quite a bit because it's going to stop a lot of the questions you'll get. Okay, so that's the credit education section of the platform. Again, that comes free with the AI. And then as long as everything's nice to me, I'll show you how the AI works. Third time is the charm. So as far as the AI goes, let's start by looking at a dispute letter. Anything you want me to show before we look at generating a dispute letter, Allie?
No, I think you showed the tutorials, which I think is important. No, I think the biggest thing is like do the disputes, right? Get them done.
Yeah.
It's so easy.
Yeah, do the dispute. So on their front page, on their dashboard, it's going to show what their current credit scores are. At the bottom here, it is going to show them what's positive, what's negative. And if they want to click on this arrow, it will expand their credit report. It's going to allow them to sort by positive accounts only, negative accounts only, things that have been repaired. And then it's separated out by credit bureau. If they want to see the details of the account, they can simply click the plus button to see the details of that account. Okay, so I'm going to go back to home. And it is also going to say at the top here when a new credit report is going to be automatically imported by Credit Score Pro. So Credit Score Pro each month is automatically going to import that client's credit report so it can do its AI magic and keep updating and adjusting so we can get them to that ideal perfect credit score. So, okay, so let's create a dispute letter. I'm going to click create dispute letter for TransUnion. For the sake of, and you'll notice the screen is very similar, we're seeing the items on the credit report. So what it's going to show me is every single negative item on this TransUnion credit report. And again, I can expand on them if I'd like to see more details. For the sake of our conversation here, and look, we can see bankruptcies. For the fun of it, let's pick bankruptcies because you had mentioned those earlier. And for the sake of our discussion, I'm just going to pick a couple of negative items just to show you because we don't need to click and see every single item on the credit report. So after I've selected a couple of items,
Can
I'm
I
going to
stop
click
you there real fast, Ivory?
back.
Yeah, so you'll click whatever items you want to dispute, right? Like Ivory was showing, and for the demo purposes, we're only clicking a few, so you don't have to go through the entire process. But if I were a client, it is absolutely 100% okay for them to click each and every single one of these
Mhm.
down their list. There's nothing that there's myths out there that you should only dispute a few a month or something like that. And that's not necessarily true. They could go and dispute all of them if they chose to.
Mhm.
But Credit Score Pro, it does all the magic for them, but it does want them to be responsible on which ones they want to dispute. So that's the reason why they can click on the ones that they want rather than Credit Score Pro deciding to click on all of them. We really want people to make informed decisions for themselves.
Yeah. Good points. Okay. I clicked next now that I chose 3 items. And the nice thing about Credit Score Pro's AI is that consumer does not have to come up with the dispute reason. They simply click add dispute reason, and the AI is going to come up with the most appropriate dispute reason based on that raw data credit file and based on historical, like what's been historically the most successful type of disputes from all users of the platform, not just this specific client's history. I think that's an important factor. It truly is learning from what the successes are in the past and what the failures are in the past. And all the client has to do is click save. Now, we'll talk about one scenario when a client wouldn't want to just take that suggested dispute reason. And that's going to be in the case of identity theft. So the AI is never going to know if an account was opened because of identity theft. There's just no way for the system to know that. So if the case was identity theft, the consumer would simply choose victim of identity theft and click save. But otherwise, we always suggest to do the AI dispute reason. And once each of the reasons have been selected, the client will simply click finish. Anything you want to add on this screen before I click finish?
No, I think you did a great job. And then finish, voila, it's done.
Now it's been created. And from here, they would just simply move on to the next credit bureau. And then it'll prompt them to go to the final credit bureau next. You're going to notice on this screen, it says your TransUnion Round 1 dispute letter has been emailed to the demo email address, but to that client's email address. And from there, that client has the option to use our internal system, which will allow a third-party mail service to mail it out for them. Or what we suggest is having that client print and mail the dispute themselves. That's always our primary suggestion, but we do know that people do like ease. They like the easy way to do things, and this is why we offer a third-party mail service to mail the dispute out for them. But for the proper consumer protections, all disputes do need to be sent by mail. Anything you want to add there?
No, you said it. I just think that was important to say that there's a lot of ways where, like Credit Karma, for instance, has where you can go online and dispute it through Credit Karma. Usually, most of the time, it doesn't work anyway. And sometimes it works temporarily. It'll come off and then come back on. But it's really important that you are always mailing out your disputes. And that's why Credit Score Pro is designed to do it that way, is because of how that works within the credit bureau system. So it's really important.
So once that dispute letter has been generated, like I had mentioned, it is going to be emailed to the user, but they can also click this dispute letters tab, and they'll be able to see the dispute here, where they could delete it if they wanted. Let's say, oh, I made a mistake. I forgot to include an account. I want to delete that and do it again. They can also click download and print. They can send it to their email. So if we click download and print, I don't know if, oh yeah, you can see my whole screen. Hold on, it went to my other monitor. I gotta move it. Okay, there we go. What you're gonna see first on the first page is instructions for how to send the letter. We don't want any confusion for our consumers or for our users of Credit Score Pro. So that being said, it tells them exactly how to send it. And then right under there is the letter itself for the dispute. And then once they do send that dispute letter, they'll mark as sent They'll select the method for how they sent it, whether they did US mail or certified mail. Again, we have that option of faxing, again, not recommended. Most people are going to do US mail, and then they're going to put the date that they mailed that out. And it gives them the option, if they did do certified, to upload the confirmation too from the certified, from the post office with their stamp. So, all right, so we'll mark that as sent. We'll just keep it as today's date. And then from there, that is how they start doing the disputes. And then automatically, when the credit report imports, it's going to compare the old report to the new report, let them know what's been removed from the credit report. This chart's going to be updated at the bottom. Their scores are going to be updated. And then hopefully at the exact same time, they're following their credit action plan that we looked at earlier. And we're going to be seeing the benefits of both the disputes and the action plan. And then on your end as a loan officer, you're cheering them on because they're seeing their scores improve and getting themselves into a position where they are truly able to transition into homeownership. Okay.
And I like how you reiterated the action plan, doing that in conjunction with the disputes. I will say that for the majority of people, if they just did disputes, that is not the full picture to get them to be able to qualify for a home loan and certainly have the best credit score. So there's more to the pie than just doing disputes, and that's why we have that credit action plan to go alongside of that. They may get themselves in a really good place because they did the disputes, but there's so much more to the process of buying a home.
So the next slide I had was looking at the action plan, but we already did that. So we're gonna, oh wait, let me screen share. So we're gonna obviously skip that. Okay, let's see. Share. You know, technology sometimes it just kills me.
Okay. You're so good at it. What are you talking about?
I don't know. I know there's like a way I can start from, I don't know. There's a way to start from the slide I was on, but I don't know what it is.
Just click.
We're almost there. Okay, we already saw the action plan. Okay, so how Credit Score Pro guides and reminds users, automated reminders. So the users of Credit Score Pro are going to be notified, making sure they're remembering to send the disputes, making sure they're remembering to follow their action plan. And then we just want to make sure that we're supporting them. Beyond that, they do also have access to our community group, and then also the webinars that we had mentioned at the beginning of today that we do every other week. So we want to make sure that they have other users cheering them on during the process. They're all sharing what's working really well for them, answering each other's questions. And then obviously Allie and I are there to support them too through the group live sessions. And then, I don't know, I suppose that pretty much covers everything. And this means that users actually fix their credit when they say they're going to. So I put that in there because loan officers that have been in the industry for quite a while have tons of stories of clients that have come to them and said, I'm just going to work on my credit for the next 6 months to a year and then I'll be ready. And then they're never ready, or it takes them 5 years to be ready. This is meant to eliminate that and will eliminate that because there's accountability, but ease of use. And I think that combination of those two is really key. And then when you add the education component into it, it gives the why behind what they're doing. So everything is cohesive and it makes sense and it's seamless.
And I think if you think about it this way, if you have a goal, you don't know how to approach the goal. You don't know what's the best thing to do first. You don't know what to do, right? And so even consumers who are trying to fix their credit on their own, they're going to sources that may not have valid information. There's myths out there. But often what I see when I hear a person say they're going to work on their credit on their own, they either A, don't do anything because their life is too busy, number one. But it's because when I dive into like, why didn't you do it? Part of its life is busy. So that's where Credit Score Pro brings that very simple, easy process to life, right? But the other thing that when I get a little deeper into it is I didn't even know how to start, right?
Yeah.
So Credit Score Pro, yeah, it's overwhelming. So Credit Score Pro walks them through each one of those. Like, okay, here's how to do the disputes. We're going to do them for you. You're just going to click some buttons, right?
Yeah.
You're going to get the action plan. And the action plan to me is like, it's like, if you have a goal, you want to lose weight, but you're like, where do I start? And then someone says, here's your diet, here's when you're going to eat, and here's your exercise routine, right? That's what the action plan to me is. It's like, here's your goal. Let's give you all the little actions that you need to take in order to reach that goal. And it just lifts this big weight off of consumers' shoulders because they're like, oh, I thought I was going to have to do this. And oftentimes we find that they do the wrong thing if they're left to their own discretion, like paying off an auto loan. I can't tell you how many clients pay off an auto loan and then think that improved their credit score, right? And so with the action plan, they have those steps and they have exactly what they need to do. And it's listed in the easiest, fastest, best things to do in the beginning, right? So not like, oh, we're going to work on this credit card that we need to pay down that has a $10,000 credit limit. No, we're going to work on the one that has a $200 credit limit, right? So easiest, fastest, best ways to do things. So it expedites the process. It gets them happy because they're seeing results faster. They have this big weight lifted off their shoulders. And then they have that educational community where they can go inside their coaching thing and see all the videos on why am I doing this, right? Or if they have questions, or if their family has questions, like they can now have expert advice at their hands. They don't have to go to social media and YouTube and get the wrong information and then pay for it later, right? So there's just so much involved in it. It's exciting to me. It's exciting because there's no other software out there that does this, that provides these resources to consumers, and it's so needed.
And at an affordable price. I think that's the other biggest thing. I mean, both of us being in the traditional credit repair space, we have made the traditional space as affordable as possible for consumers, but the trouble is there's a lot of people that are charging quite a bit more. But even as affordable as we try to make it, that's still not necessarily affordable for everyone, right? And we want to give opportunity to everyone. And so that's the goal. And so we hope that having this resource as part of your toolkit will help you to not only generate more business, but help put your clients in a better position to buy. And then also for those of you that are in Georgia, you'll be able to offer a service that can't be offered in your state through that traditional credit repair model.
Exactly. Yeah, because they're not paying for credit repair at that point, and Georgia has a law against credit repair. So they're actually doing it themselves and with the resource of the software, and what they're paying for is the credit monitoring, which we didn't even get into that. The credit monitoring itself has a lot of benefits by itself, even without having Credit Score Pro. So we partnered with Smart Credit, and Smart Credit gives the clients Privacy Master. So it's constantly scanning the web to find the dark web to find information of where your information is being sold. So I tell everyone, whether or not you have credit issues or not, you need Credit Score Pro because of all of what you get with it. It's going to monitor your credit. If something does pop up that's yours or not yours, it's negative, it's going to handle that right. It's got your action plans. But then you have this $1 million insurance protection against identity theft. You have the Privacy Master scanning constantly the web to see where your information is being sold. It does that every 14 days. You could take action to have your information removed from that, which I'm telling people you got to do that. It's really important. We're in a high state of identity theft, and we need to take all the protections we can. And so Credit Score Pro combined with Smart Credit just provides all that for a person, whether or not they have credit issues, right? Maybe they just want to get out of debt. So the action plan will even give them a plan for getting out of debt. There's just so much that Credit Score Pro offers for that small payment of the $39.99 a month.
So I think we'll leave it open from here. If anybody has any questions, we welcome your questions. Of course, we welcome them during the live, but if you wanted to wait till the end, feel free to ask any scenario specific questions about credit or the software itself. And Allie and I are here for you.
And I think, is our contact information also available for if they'd like to, maybe we should put that in chat?
Yeah, let's put it in the chat.
Okay.
I'll type it right now.
You type it, thank you. That way, if you guys do, I know sometimes getting on a live stream and talking or asking questions, number one, you can type it in the chat if you'd like, and we'll just read it off. But if you want to have just some one-on-one time with us, You can email us. If you have questions, you can email. If you would like to be an affiliate, we have at the top of the chat, I put in our affiliate link. You just click on that and then
I'll
we'll get
paste
with
it in
you.
again.
You want to paste it in again? Okay,
Yeah.
thank you. Yeah.
Okay. I think we must have done an excellent job. And again, every other Thursday, we'll be going over different topics. Please feel free if you have a particular topic you would like us to zero in on and maybe hyper focus on anything. We are happy to go more in depth on a topic or cover something we have not addressed in today's live. You can put that in chat, shoot us an email. You can also, I guess I'll put in our community group as well. You're welcome to put it there too. And I'm putting that now, but otherwise, while I type, Allie, if you want to close things out, we can call it good for today, for this Thursday's webinar.
Well, first of all, I'm so glad that those of you who were able to attend our live event are here. We appreciate you. It's really weird to do a live event when no one's on. That does happen because schedules are crazy. And I'm wondering how next week's going to flow. Yeah, but it's we love this. We love teaching. We are absolutely 100% here for you. We want to help you grow your business. And we hope that the resources with Credit Score Pro, the software itself will help you. But if we can help you in educational pieces as well, marketing, I'm a business coach as well. So I do business coaching, helping you market, helping you grow your business, especially if you're new to the industry, kind of learning the ins and outs. There's just so many resources that we can provide to you. So please feel free to reach out to us. We'd love to help you.
Check out our social media too. There's a lot of videos on there you can share with your clients, especially on inquiries. It's every consumer's favorite, but we'll let you guys get back to your Thursday evening, and then we hope to see you here in a couple weeks, or feel free to attend all the consumer events too. They're all great. So
yeah, awesome. Thank you guys. Have a great night.
bye everyone.
Bye.
Bye. Thank you.
Thank you.